You described the recent slide, Chair Powell, in inflation expectations as unwelcome. You said that inflation expectations are very important. What, if anything, would the committee be prepared to do to address this slide in inflation expectations if it continued?
So, as I mentioned, we do think that inflation expectations they're quite essential, quite central in our framework of how we think about inflation. We need them to be anchored at a level that's consistent with our symmetric 2% inflation goal. We think that we need to conduct policy in a way that supports that outcome. That's what we're doing now. We're also, as part of our review, looking at potential innovations, changes to the way we think about things, changes to the framework that would lead us, that would be more supportive of achieving inflation on a symmetric 2% basis over time. That's at the very heart of what we're doing in the review. It's too early to be announcing decisions. We haven't made them yet, but we're in the middle of thinking about ways that we can make that symmetric 2% inflation objective more credible by achieving symmetric 2% inflation. And it comes down to using your policy tools to achieve 2% inflation. And that is the thing that must happen for credibility in this area. So we're committed to doing that.
Do you think that review might be announced to the public?
So we're in the middle. We're really quite in the middle of it now. And my thinking is still that it will run into the middle of next year. These changes to monetary policy frameworks they don't happen really quickly, let's say. Inflation targeting took many years to evolve. I don't think we'll take many years here. I think we'll wrap it up around the middle of next year would be my guess. I have some confidence in that.
Edward Lawrence with Fox Business. Thank you, Mr. Chairman, for taking this. So how big of a change then to monetary policy would there be if you get some of that uncertainty cleared up, specifically the Phase 1 China trade deal finished and USMCA ratified? How big of a change could that be to the monetary policy as it stands here? And could we see rate cuts next year? Or rate hikes next year, I'm sorry.
Rate hikes for next year.
Yeah, because I've heard the argument that trade's causing the uncertainty is keeping the prices low. I've heard that argument from a Fed president from one of the districts. So you remove that uncertainty, prices then would naturally rise. So then could there be a point, or I guess my question is how big of a impact on monetary policy would removing that uncertainty?
So I would just say that if we were to have a sustained reduction in trade tensions, broad reduction in trade tensions, and a resolution of these uncertainties, that would bode well for business sentiment, which is trade uncertainty has been weighing on business sentiment in our judgment and the judgment of many analysts. And ultimately, it could affect activity. I wouldn't expect that the effects on activity or confidence would be immediate or would there be immediate effects in economic activity. I think it would take some time after the recent things. But I do think it would be quite positive over time. You come back to the question of raising rates. So that's really about inflation. And, we haven't yet, we just touched 2% core inflation, to pick one measure, just touched it for a few months, and then we've fallen back. So I think we would need to see a really significant move up in inflation that's persistent before we even consider raising rates to address inflation concerns.